2023 is going to be a tough year. The index is down almost 21% with $8 trillion vanishing into thin air. For the casual investor, that big red line looks scary, but the smart value investors see nothing but dollar signs. The entire market got hit with the COVID bubble burst, so now's the perfect time to go browse around while every stock's selling for dirt cheap. Although here at CJ Capital Management we strive in hiring the best finance analysts the industry has to offer, we like to take a peek at what the real experts of the industry are doing. Thanks to their asset sizes, many hedge funds have to disclose their holdings, so we get a look inside to what the richest of the rich are doing to maintain their massive piles of gold. The beautiful brains of the industry experts here at CJ Capital Management have narrowed down our list of the highest growing companies of 2023 that are owned by some of the largest hedge funds in the world. This video should not be interpreted as financial advice. Please do your own research before investing in securities of any type. Zscaler is the largest network security cloud company in the world, and with over 40 hedge funds invested, it gives me confidence that other finance nerds agree. Big research company Gartner has recognized Zscaler as the industry leader for the past 11 years, with a major competitive differentiation stemming from their large scale and innovation. Zscaler operates the largest security cloud in the world, with an AI engine learning from 300 trillion security signals every day, giving them faster information and better intelligence than their competition. Customers of the industry love this, and it showed as they increased their customer count by 20% this year, and on average, each customer increased their spending by over 25%. Their revenue rose 61%, and free cash flow went crazy, going up 170%. Credit Suisse, however you say it, a Swiss investment bank, put a target price of $275 per share, basically saying their estimates believe that there's over 127% upside from the current price. With growing trends in the cloud computing and software as a service industries, their demand and markets are both projected to keep expanding. PayPal has had an awful year, with their stock price going down over 56% or over half its trading price. This can be really scary when you're just looking at the graph, but true value investors' eyes light up when they see an undervalued company like this. PayPal is one of the largest online payment platforms with over 432 million active users. They provide hardware, software, and financial services to help people run e-commerce stores and are working their way into the brick and mortars. Additionally, they have acquired many industry leaders like Honey and Venmo, which fit in perfectly with their portfolio and really help expand their services. Their scale and brand name is what we believe makes them so undervalued, as their network is so massive it will allow them to stay at the top for a very long time, not to mention how trusted their name is. I mean, their CEO, Dan Schulman, did say that customers are 2 times more likely to shop when a PayPal button is present at an e-commerce checkout, which actually checks out as PayPal has been the most accepted digital wallet in North America and Europe. This third quarter, they beat all their estimates with year-over-year revenues increasing 11%, and free cash flow going up 37%. They're better with their assets, cutting $900 million in savings this year and $1.3 billion projected in savings next year, according to their management, which should hopefully boost their operating margin by at least 1% next year. PayPal claims its potential accessible market sits at $110 trillion, but it currently only processes around 1.4 trillion in payments annually, so there's a ton of room for growth. They recently got Amazon to accept Venmo payments, which is huge, but thanks to the high trust that e-commerce customers already have in PayPal, a lot of their focus is on building that same trust with physical locations, and recently they deepened ties with Apple to do just that, hoping that soon merchants will accept payment through their PayPal and Venmo mobile wallets. Next year, they are even releasing PayPal and Venmo branded payment cards, as you've probably been getting spammed in your inbox about all the companies doing the same thing. With 66 hedge funds or asset management firms currently owning Atlassian, it's pretty easy to see why. They're basically the leader in the business collaboration and productivity software industry. Its most famous products are Jira and Confluence. Jira is regarded as the #1 software development tool used for product management and bug trafficking, while Confluence has been labeled the gold standard in knowledge sharing. Atlassian has a major presence in other end markets, including enterprise planning and IT service management software, which puts them everywhere in the online business landscape. They really just sell online products, so sales and marketing costs are really low without a fat sales team, allowing them to spend more on product development than its competitors. They got hit heavy with their first fiscal quarter results that ended September September 30th, as their fiscal calendar is different than the normal calendar. Their year-over-year quarterly rev went up 31% and net loss improved to 5 cents per share. But since they fell short of estimates, Wall Street had a field day, dropping their share price by over 20%, which should signal a discount to investors as management has put their capturable market at $29 billion. And with the growth of the online office space, that $29 billion is growing at 14% annually, which means they have plenty of customers available and a ton of room to grow. Keith Weiss and Morgan Stanley put a price target of $375 on them, which implies a 203% upside from its current price. So that should tell you that analysts think pretty highly of these guys. Cloudflare is another one of the leading providers of cloud services and applications for the business world. Their recent earnings were solid, beating estimates of EPS by 6 cents, posting a revenue of $253 million, which was up over 47% year over year, and they beat their estimates by $4 million. They got a ton of exposure to various high growth areas, including content delivery network, edge computing, and security. Both the content delivery network and edge computing are new trends for large database companies trying to make data available quicker and easier. After the second quarter this year, 41 hedge funds and capital management firms held a combined $541 million in Cloudflare's stock. A lot of monetary belief. One such fund, Barron Funds, talked about why they're strengthening their position recently. We continue to build our positions in Cloudflare Inc. during the quarter as the shares declined with the overall software space and the long-term risk-reward balance became more compelling. The company reported a strong second quarter with revenue growth accelerating to 54%, as well as better gross and operating margins. Given Cloudflare's proprietary network and massive global scale, its software products have a disruptive price performance advantage over competitors. They later go on to say the company already well ahead of its long-term gross margin target of 74%, reporting 78.9% for the second quarter. This drives strong cross and upselling activity with customers, reflected in their strong net dollar expansion rates in excess of 125%. Basically, with their recent drops in share price and major disruptability potential, most large investors' mouths are watering at the chance to hop in on this. Now, if you only take one thing away from this video, it should be that Block is a gold pile selling for dirt cheap. These guys are an absolute titan, and the numbers speak for themselves. This third quarter, they beat expectations with revenues of $4.5 billion and EPS of 42 cents, making every hedge fund exec reach for their checkbook. Their big product is that little device that guilts you into giving some awkward teen a 15% tip. The Square alone posted gross profits of $783 million, up 29% year over year. And that minor little startup called Cash App is their other major product, posting gross profits of $774 million, with 49 million active customers in September alone. Their CFO even thinks their potential market is over 190 million, which means they're only reaching about 3%. Since doomsday preppers and your local trap goon are the only people carrying cash, Block's potential is going through the roof. And with a historically great looking stock chart, you can tell that this last year is just them feeling the effects of the COVID bubble as a whole. And with an average target price around $90, it's pretty obvious why most analysts are recommending buys. Thanks for checking out the video. If you learned anything or you think I'm unfunny, please let me know and subscribe. I got a few more videos already cooking up, including a longer breakdown over some interesting figures in the news right now. Kind of trying something new, but I think you guys will like it, so stay tuned. I'll see you around.